Ledger wanted to understand how wealthy investors keep growing real estate portfolios, because every time a normal person thinks about selling property, one word appears: taxes. If an investor buys a building for $400,000, then sells it later for $600,000, that profit can trigger capital gains tax. Ledger thought the game was simple: sell, pay tax, start again with what is left. But wealthy real estate investors often use a different move. They do not just sell the property, they exchange it. That is where the 1031 exchange comes in, a legal strategy that lets investors defer capital gains tax when they swap one qualifying investment property for another. First, Ledger sells an investment property, but he does not touch the money directly. A qualified intermediary holds the funds. Then the clock starts. He has 45 days to identify replacement properties and 180 days to close on the new one. So instead of taking the profit, paying tax, and shrinking his buying power, Ledger rolls the money into a bigger property. Maybe he sells a small rental building and moves into a larger commercial space. The tax is not gone. That is the part people miss. It is delayed. If he eventually sells and does not exchange again, the tax bill can come back. And the rules are strict. It must be qualifying real property. It must be investment or business property. And if the timeline breaks, the strategy can fall apart. But when it works, the investor keeps more capital moving. More capital means bigger properties. Bigger properties can mean more income. And more income can mean faster portfolio growth. That is why wealthy real estate investors do not always ask, "How much profit did I make?" They ask, "How much profit can I keep working?" Follow Ledger for more hidden systems explained.